Friends, let's first write the summary of the earlier area. So we were yet to write the summary entirely for capital budgeting. Which is the last question we wrote? Summary in investment decision. 23. Question number 23. Okay. We are, I think we didn't write 16 onwards, 15, and then I moved in between to 23. Now write question number 16. Question number 16. Point number 1. The company is planning for a replacement. The company is planning for a replacement of machine Z. Is planning for a replacement of machine Z. And it has two options. Machine X in bracket machine X and machine Y. Machine X and machine Y. Next point. We will solve this problem under non-incremental method. We'll solve this problem under non-incremental method. And the NPV would be separately computed. For the three machines. And the NPV would be separately computed for the three machines. Next point. Select the machine which has the highest positive NPV. Next, question number 17. Point number 1. Problem on replacement decision. Hyphen information on outflows is only available. Information on outflows is only available. Next point. We will have to compute the cash flows. In step 1, 2 and 3. We will have to compute the cash flows in step 1, 2 and 3. Compute the cash flows in step 1, 2 and 3. Next point. In this step 4, we will have to first compute. In this step 4, we will have to first compute the incremental cash flow. And then calculate NPV. We'll have to first compute the incremental cash flow and then compute NPV. Next point. Incremental cash flow equal to cash flow of new machine minus cash flow of old machine. Cash flow of new machine minus cash flow of old machine. Question number 18. Point number 1. The company has already decided on replacement. And is not sure and is not sure about the timing of the replacement. And is not sure about the timing of the replacement. Next point, we will have to compute NPV of the alternatives, NPV of the alternatives, and then calculate EAB, to make the decision, Next, question number 19. Point number 1. Book value of existing machine. Book value of existing machine will be 0. Book value of existing machine will be 0. As it has been fully depreciated for tax purpose. As it has been fully depreciated for tax purpose. It has been fully depreciated for tax purpose. Next point. Allocated corporate overheads. Just adjust that one. Allocated corporate overheads. Allocated corporate overheads will be ignored. As the same as a distribution of cost. Allocated corporate overheads will be ignored as the same as a distribution of cost. Next point, depreciation of existing machine. Depreciation of existing machine will be taken as 0. Due to fully depreciated book value. Will be taken as 0 due to fully depreciated book value. Next, write chapter 4, cost of capital. Chapter 4, cost of capital. Now write the general points and then I come to specific question. Point number 1, cost of irredeemable debt. Cost of irredeemable debt equal to interest after tax by net proceeds. Interest after tax by net proceeds. Next point, interest after tax equal to interest into 1 minus tax rate. Next point, net proceeds and divide into 2. Net proceeds and split it into 2. Existing issue, new issue. Net proceeds and split it into 2. Existing issue, new issue. Existing issue, put arrow mark down, current market price. Existing issue, current market price. New issue, issue price minus flotation cost. Next point, cost of redeemable debt. Equal to cost of redeemable debt equal to interest after tax plus average other costs, interest after tax plus average other costs divided by average funds employed, Next point, average other cost equal to redemption value minus net proceeds, by balance life, Next, average funds employed equal to redemption value plus net proceeds by 2, Question number 1, 2, 3, no special adjustment. 1, 2, 3, no special adjustment. 1, 2, 3, no special adjustment. Question number 4, 5% underwriting commission. 5% underwriting commission can either be taken as a percentage of face value or issue price. Question number 5, net proceeds in this question, which classes? See, no, this is for CA Inter. No, this classes is for CA Inter. So your class will be in the second floor just. Net proceeds, what have we written? Net proceeds in this question will be current market price. Net proceeds in this question will be current market price, as it is an existing issue. Next, question number 6, 7, 8, no special adjustment. 6, 7, 8, 10, no special adjustment. Question number 9, this is a question on optionally convertible debt. Optionally convertible debt. Next point, redemption value will be taken as higher of the expected equity value, and the normal redemption value of debt. Normal redemption value of debt. Question number 11, fair market price of debt equal to interest amount divided by investor expectation. investor expectation slash current yield. Interest amount divided by investor expectation slash current yield. Just make a small change. Fair market price of irredeemable debt. This is FMP of irredeemable debt. FMP of irredeemable debt. Next point. Fair market price of redeemable debt. Fair market price of redeemable debt is the present value of future cash flows, in bracket interest plus principal, present value of future cash flows, interest plus principal, discounted at investors required rate of return. Discounted at investors required rate of return. Discounted at investors required rate of return. Question number 12, no special adjustment. Question 12, no special adjustment. Okay, I'll now proceed with few more problems. I'll give the balance summary later on. Whatever is that pending problems which we have done in cost of equity. Now just to summarize whatever we have done till now in cost of equity, we have done a broad categorization which stated that there are two types of companies. Companies paying dividend and companies not paying dividend. In case of not paying dividend, we had a formula called as CAPM, which was RF plus beta into RM minus RF. This is the formula we had introduced. RF refers to risk-free rate, RM refers to market return, and again RF refers to risk-free rate. B symbol was beta. Beta basically measure how risky a security is. Then if the companies are paying dividend, then we adopted a formula called as, is there a no growth or a constant growth or a step up growth? Step up growth will be learnt in dividends chapter. No growth or constant growth, the formula is no growth. Coming to no growth and constant growth, the formula which we had used was D1 by P0 minus F. P0 minus flotation cost plus growth rate. Plus growth rate is added in both the formula. When there is no growth, plus growth becomes 0%. That's why I gave two different formula. But as such, it's a single formula only, where plus growth will come in both the scenario, and one scenario plus growth will be plus 0%. So that doesn't make any difference to my answer. For calculating growth rate, we had done two scenarios. One is called as point-to-point model, wherein you take the first dividend and the last dividend and see what has been the average growth in the dividend. And the second was a formula which was IRR into retention ratio. IRR into retention ratio. Any doubts till that? We are done with question number 17. Let's do question number 18. Mr. Mehra, is the display proper? Okay. Mr. Mehra had purchased the share of Alpha Limited for ₹1000. He received dividend for a period of 5 years at the rate of 10%. At the end of 5th year, he sold the share for ₹1128. You are required to compute the cost of equity as per realized yield approach. Now listen, what is realized yield approach is technically called as calculating the IRR of the cash flow. So I'll create year cash flow and we have to compute IRR. I'm not going to do IRR calculation in this class. I'll tell you the answer. At home you will get one positive NPV, one negative NPV and get to the IRR. It's basically IRR computation. You will get year cash flow. You will start with an initial guess rate. If you remember what we used to do, 2/3 of ARR on average investment. So we used to calculate ARR on average investment and do 2/3 of that. That's the initial rate. Get a positive NPV, get a negative NPV. I'll take you through the cash flow structure, tell you the answer, but at home you can compute the IRR part. Clear? Any doubts on this? Let's start. calculation of cost of equity, calculation of cost of equity as per realized yield approach, cost of equity as per realized yield approach, in brackets IRR. In simple words, it's IRR. I'll get you to the year-end cash flow. You can have space for 8 columns so that you get one positive, one negative and all. That part is up to you. So I am opening the year-end cash flow column. I am taking you through year-end cash flow. Apart from this, you will have to do PVF, DCF, PVF, DCF. I don't want to spend time on IRR computation at this point of time. Year 0, what is the investment we are doing for this asset? How much? 1000. So I pay 1000 rupees in year 0. Year 0, the payment is 1000. Year 1, what do we get back? CMA? CMA, no? It will be in the next floor, second floor. Year 0, 1000 outflow. Now when it comes to year 1, 2, 3, 4, 5, every year we are earning dividend at the rate of what they have said? 10%. Dividend will ideally be on the face value. I don't know what is the face value. So I assume maybe 1000 is the face value. We don't have information on the face value. So listen for some time. Year 0 you invest 1000. Year 1 you will get back 100. Year 2 you will get back 100. Year 3 100. Year 4 100. Year 5 100 plus 1128. This is the cash flow structure. You want to write as annuity, you can write it. Why I have done it like this? Just to get the IRR quickly. So you can note down the answer for the IRR part. The IRR is going to be 12% in this case. So that is the cost of equity. This is the cash flow structure. It's 12%. In fact, exactly 12%. You can do the calculation at home. The answer will be 12%. The IRR is the cost of equity. IRR is basically the cost of equity. Clear? Any doubts on this? Can we proceed? Done? Any doubts on this? Let's move through question 19. The risk-free rate of return is 8%, beta is 1.4, risk premium is 6%. Compute cost of equity using capital asset pricing model. It's write the formula, get the answer. That's all. We don't have anything beyond to explain here. Now write KE equal to RF KE equal to RF plus beta into RM minus RF. RF plus beta into RM minus RF. What is the risk-free rate they have given in the question? How much? 8%. 8%. Beta 1 point. 1 point, how much you said? Okay, 1.4. Any doubts, please let me know. 1.4. What is RM? 6%. RM is? Can it be 6%? When your risk-free rate is 8%, can market return be lower than risk-free rate? What is the word used there? Risk premium. Premium means extra return. So risk premium technically means extra return, and market has to give an extra 6% return. Market has to give extra 6% return. So you can understand either market return is 14 or RM minus RF is directly 6. RM minus RF is directly 6 because that is the premium. That is the extra return on the security. So you can either understand it as RM minus RF is equal to 6% or RM is 14 and 14 minus 8 is 6%. So whatever way you want to do it, I am writing it as 14 minus 8. You learn more about CAPM at final level. Clear? Can you proceed? Let's do the next one, which is quickly close it. Question number 20. Apply the formula and get to the solution. How much is it? 18.75. It is 10 plus 1.75 into 15 minus 10. 10 plus 1.75 into 15 minus 10. You get it as 18.75%. Can we proceed? Okay. Go through question 21. Okay, now let's go through this question. A company share is quoted in the market at rupees 40 currently. It pays a dividend of 2 per share and investor expect a growth rate of 10%. Company's cost of capital. The term cost of capital in this context has to be understood as cost of equity. It is cost of capital though given in the question, but in the context of this question it is cost of equity. The formula which we will use is D1 by P naught plus growth rate. Wait for some time. After calculating this cost of equity, you will rewrite the same cost of equity and same formula, but change the growth as 11%. When you change it as 11%, the balancing figure will be P naught. The balancing figure is going to be P naught, because when with 10% you will get a cost of equity. If that cost of equity continues with 11%, obviously the price has to undergo a change. Third part, they are giving some cost of equity, they are giving some growth rate, and again the balancing figure is market price. Now the only important assumption is this 2 rupees which is given in the question, is it D0 or D1? D0 or D1? Ideally it is D0, that's what I would prefer, but last line of the question, dividend of 2 per share is to be maintained, which maybe they are indicating that it is going to be paid in some 6-7 months time, and it's kind of a futuristic dividend. Always there will be an issue with this D0 D1 classification. Whenever there is an issue, you write your assumption. In this problem, my assumption of D0 may not work, because they have clearly mentioned in the last part saying that dividend of 2 per share is expected to be maintained. Clear? Any doubts on this? Let's start part 1. KE equal to, otherwise there's nothing much in this question. KE equal to D1 by P naught plus growth rate, D1 by P naught plus growth rate. What is the dividend? 2 by 40, 2 by 40 plus 10%, 2 by 40 plus 10%, 2 by 40 you get it in percentage first. 2 by 40 will be 5%, 5 plus 10 is 15%. Any doubts on 15%? This is for part 1 of the question. Again I am going to repeat it for part 2 of the question. Same formula, we are going to use the same formula, right? KE equal to D1 by P naught plus growth rate, D1 by P naught plus growth rate. K is what? 15% equal to 2 by P naught plus 11%. 2 by P naught plus 11%. 2 by P naught plus 11%. P naught will become a balancing figure. It's a balancing figure. 2 by 4%, rupees 50. 2 by 4%, rupees 50. Any doubts on this? Clear? Can we proceed? Any doubts on this? Next, third part. Again same formula. K is equal to D1 by P naught plus growth rate. K is how much? 2 by P naught. Growth is? $33.33. Clear? Any doubts on this? Can you proceed? Now next I'll go to retained earnings. Now let's first understand this cost of equity which we calculate is basically the cost of any new issue of shares being done. In a company's balance sheet, there is equity capital, there is also something called as a reserves and surplus. That's technically called as retained earnings. Other name for retained earning is internal equity. Equity capital is called as external equity and retained earnings is called as internal equity. Now, when any company without declaring dividend, if they hold back that money, if they are not declaring dividend and they are retaining it with themselves, shareholders expect some return on that also. That is technically called as cost of retained earnings. What is cost of equity? The return which shareholders expect on external equity. What is cost of debt? The return which the debenture holders expect. See, from company point of view, it's called as cost of debt. From a debenture holder point of view, it's called as return on debt. From a company point of view, it's called as cost of equity. From your point of view, it will be called as return on equity. So when a company is holding back my money, I need a return on that also. Now they say cost of retained earnings, KR, will be equal to KE. It will be equal to KE except for two scenarios. One, if there is a flotation cost in a problem, then the formula will undergo a change. Why? Because when you are issuing shares, there is a flotation cost. But when you are retaining money, there is no concept of a flotation cost. So all the formula which I gave, the denominator used to be P0 minus F. If there is a flotation cost in a problem, for KR purpose, the denominator will be only P0. It will be only P0. No concept of P0 minus F. D1 by P0 minus F minus flotation cost should not be done for retained earnings. The reason for that is, in case of retained earnings, I do not incur any flotation cost. Let me just see whether I have covered it in the theory part. Okay, it's covered in the theory part. Let me explain and then I'll show it here. So one change is, you will not do this denominator of P0 minus F. The second part is, if at all some personal taxes are given in the question. Personal taxes, not corporate taxes. If at all personal taxes are given, what they say is, when you declare dividend, shareholders get the dividend. When shareholders get the dividend, they may have to pay tax on it. So in case of equity, tax is an extra expense, so shareholders will expect more return. In case of retained earnings, that money is left with me. I'm not paying anything to the shareholders, so there is no concept of tax on retained earnings. So two scenarios, one flotation cost, second personal taxes. If there are flotation cost, they say P0 minus F is replaced with P0 in the formula for cost of equity. P0 minus F is replaced with P0. So it will become D1 by P0 plus growth rate, D1 by P0, and CAPM remains the same. There you don't have this D1, P0 and all. Second, if there are personal taxes, this is the formula they have introduced. There is no major logic behind it. This is the formula. We just need to remember. KR is equal to KE into 1 minus personal tax rate. Why I am doing 1 minus personal taxes? That will reduce the cost of retained earnings. The moment you multiply with the 1 minus personal tax rate into 1 minus flotation cost. The cost of retained earnings is obviously expected to be lower than cost of equity. KR has to be lower than KE because of two reasons. No personal taxes, no flotation cost. So if a problem has flotation cost, don't replace, put in place of P0 minus F as P0. And the second part is, if at all a problem gives you personal tax, again I am telling you, they'll say the shareholders are in 20% tax bracket, or the shareholders are expected to pay a tax of 10%. If that information is available in the question, then the formula is KE is equal to KR into 1 minus personal tax rate into 1 minus flotation cost percentage. Clear? Any doubts on this? Clear? Now, may not be that much relevant from Indian point of view, from India's point of view, because in India dividends have become tax exempt. The dividends which a company declares are tax exempt, but technically it is not tax exempt because the corporate will pay something called as a dividend distribution tax. So that has been done earlier. Dividends used to be taxed and company was not paying tax on it. Now companies have started paying something called as DDT, corporate dividend tax or dividend distribution tax. So if at all a problem has personal tax information, then you will have to do this adjustment. Let's go to a problem on this. Question number 22. Y Limited retains 7,50,000 out of its current earnings. The expected rate of return to the shareholders if they invested the funds elsewhere. Now listen, I'll keep explaining as I read the line. Expected rate of return to the shareholders is technically cost of equity. What my shareholders expect is cost of equity. So in a problem, if you don't have any information on calculating KE and they say people are expecting 5%, K is 5%. People are expecting, see, what you expect is what I have to give. So if you expect something, that's called as KE and I have to give you that. What I earn is called as ROE. What I have to give is called as KE. What you expect is called as cost of equity and what you actually get is called as return on equity. What I give and what you get is return on equity. What you expect and what I bear as a company, what am I bearing is called as cost of equity. The brokerage is 3%. What is brokerage? Flotation cost. Shareholders come in 30% tax bracket. This is called as personal tax rate. Now write KR equal to KE into 1 minus personal tax rate. 1 minus personal tax rate into 1 minus flotation cost percentage. 1 minus personal tax rate into 1 minus flotation cost percentage. What is KE? 10% into 1 minus 0.3 into 1 minus 0.03. Just switch on the display. Just a minute. Is a green light coming there? Click, maybe press it twice. 1 minus personal tax rate into 1 minus flotation cost percentage. What is the number you get? What happened? Minus? What is the formula given? 1 minus flotation, no, this is wrong. It is into. That personal taxes and flotation cost, no. Cost of equity into 1 minus flotation cost percentage into 1 minus personal tax rate. It has to be into. you'll have to change the formula. It's into 1 minus personal tax. What's the answer we get? 6.79%. Any doubts on 6.79%? Now we have done till cost of debt. In cost of equity, we have done external equity and internal equity. These are the three major components. The only thing which is pending is preference now. Preference, I'll first explain the formula. Preference, the formula is same as debt. What is the formula for cost of irredeemable debt? Irredeemable debt. Interest after tax by net proceeds. Here the formula is preference dividend divided by net proceeds. Preference dividend divided by net proceeds. There is no concept of after tax and all, because dividend is not a tax deductible expense. PGBP doesn't allow it to be deducted for calculating your taxable income. So the formula is preference dividend divided by net proceeds. How do you get net proceeds? New issue, issue price minus flotation cost, existing issue, current market price, everything remains same. What is the formula for cost of redeemable debt? Interest after tax plus average other cost divided by average funds employed. Here it is preference dividend plus average other cost divided by average funds employed. What is average other cost? Redeemable value minus net proceeds by balance life. What is average funds employed? Redeemable value plus net proceeds by 2. Everything remains same. The only change which I wanted to say is, instead of interest after tax, you will call it as preference dividend. Clear? Any doubts on this? It's not interest after tax, it will be preference dividend. Clear? All other rules remain same. If the problem does not give information, issue will happen at par. Redemption will happen at par. If face value is not given, you assume 10, 100, 1000, whatever number you want to assume. All those rules will exactly continue here. The only change I am talking about is, instead of using interest after tax, you will use preference dividend. Clear? Any doubts on this? And the short form is we use KP. Let me just see the formula. In fact, I have not given the okay, yeah, it's here. Cost of irredeemable, cost of redeemable, it's covered in question number 4, but it's broadly the same thing. I don't want to even, just a minute. Okay, we'll directly get to those problems now. I'll not be doing any of these problems. You will read it, you will do it on your own. Question number 23, go through it and do it. I don't have anything to explain in preference. If you get stuck somewhere, I'll help you out. Otherwise, it is continuation of cost of debt. You can see the problem as debenture. You can read it as 8.5% debenture also, doesn't make any difference. Read it and try doing it. In case you need any guidance, let me know. What's the answer to 23? How much? Where did 4.25 come from? It's 8.5. It's a tax. It's not a tax deductible expense. Why are you deducting the tax of 50%? Preference dividend is 8.5. Your face value is 100. 8.5 by 100 is the answer. Where is the tax coming into picture? It's not a tax deductible expense. They are purposefully given the tax rate in the question. That doesn't mean that I'll have to deduct tax and do my calculation. Your preference, I told initially also there's only one difference. Preference dividend vis-a-vis interest after tax, and it can't be after tax because it's not a tax deductible expense. So it's 8.5 divided by 100. Answer is 8.5 divided by 100. Assuming face value to be 100, you assume 10, it will become 0.85 by 10. You do it in any formula, you'll get 8.5%. Any doubts on 23? Can you proceed? Do 24. Till 27 you will do it. I'm not going to even explain any of them. I'll just tell the answer. Read it and do, that's all. In case you need any guidance, do let me know about it. I'll clarify. The formula is preference dividend by net proceeds. For first one it is 10 by 95. Second one it is 10 by 105. 10 by 95 and 10 by 105. I don't see any scope for confusion. If you still have, let me know. 10 by 95 and 10 by 105. Ten by 95 and 10 by 105. In case anybody still needs an explanation, please let me know. The formula is whatever we have done in debt. I'm using the same formula here. Do question 25. You can refer to the board for verification purpose. How much? 10 point? %10.4%. In case there is any confusion, do let me know. Interest after tax plus average other cost divided by average funds employed. After tax plus average other cost divided by average funds employed. Any doubts on 25? Do 26. 26, 27, complete all of them. Any doubts on question 25? Anybody needs any explanation on 25? Do 26 then. It's same as cost of debt. You should have ideally revised it, or it should be clear because we have just learnt few days back. It should ideally be clear for you. 12 by 97. Any doubts on 12 by 97? Your 97 is redeemable value minus, net proceeds, issue price minus flotation cost. Your net proceeds is issue price minus flotation cost, which is 100 minus 3. 100 minus 3. 12 by 97. Any doubts on this? I'll then proceed to WACC. That's where bulk of exam problems will be. Any doubts till now? Can I proceed? Any doubts? Okay, now please listen. Till now, whatever we have computed is individually debt, individually equity, individually preference, individually retained earnings. When any company does a project, there is a year cash flow PVF at the rate of cost of capital and DCF. So, cost of capital refers to the single cost for the entire capital structure of the company. So, for the entire company, I need a single cost. You cannot tell me equity is so much, debt is so much, preference is so much. So, that is what we are going to learn now. Weighted average cost of capital, WACC, refers to a single cost for the entire capital structure of the company. For the entire capital, there will be a single cost, that is called as WACC. Now, how do we solve a WACCs? When we see a problem on WACC, they ask for a single cost. Your step 1 will be computation of cost of individual components of capital. That is, you will separately calculate KE, KR, KP, cost of debt. All of this will be separately calculated. So, a question will have some 20 lines. In that 2 lines will be on debt. Take those 2 lines, get cost of debt. Take another 2 lines, get cost of preference. Another 2 lines, cost of equity. Another 2 lines, cost of retained earnings. That is your step 1. Whatever I have done till now, if you have learned, understood that, then only we will be in a position to do the next 5-6 question. So, whatever I have done there, I will have to use here and get the cost of debt, cost of equity and cost of preference. After getting that, I will put it in a format to get weighted average. You would have learnt about how to compute weighted average. The same thing we are going to do here. I need to compute weighted average. There is a format for it. I will come to that format in some time. But whatever I am going to teach beyond this, is it anything going to be new? No. Everything you have learned till now. Whatever you have learned till now, we are going to do it in a comprehensive problem and get an answer called as WACC. Exactly whatever we have done till now is what we are going to continue now. Clear? Let us do question number 28. 3 companies A, B and C are in the same type of business and hence the similar operating risk. However, the capital structure of each of them is different and the following are the details. Particulars A, B and C. So, they have given details about 3 companies. Equity capital, market value, DPS, debenture, market value and interest rate. Assume that the current level of dividends are expected to continue and the income tax rate is 50%, you are required to compute WACC, weighted average cost of capital or Wacc for the company. Now, in order to do WACC, I need to first find out how many components of capital are there and get the cost of those components. Working note 1, cost of individual components of capital. Working note 1, cost of individual components of capital. Cost of individual components of capital. Cost of individual components of capital. In that, write firm A and underline that. We normally use the word firm instead of company. Firm A. Now, what are the various components of capital firm A has? Equity. Is there a debt firm A? Only equity. It has only equity. So, I have to calculate KE. Now, wait. Then again same rules. Company paying dividend, not paying dividend. Is this company paying dividend, not paying dividend? Paying dividend. Constant growth, no growth, step up growth. Current level is expected to continue indefinitely, which means there is not going to be any growth. Otherwise, any problem, if you don't have information on growth, growth is 0 only. If you don't have information on growth or you cannot compute using IRR into retention, growth is 0. So, basically you will do K is equal to D1 by P0 and get the cost of equity. That is all. K is equal to D1 by P0 and we are done with cost of equity. The rules remain exactly the same what we have done earlier. I am not going to change them and all. I'll continue to be doing the same thing. So let's write firm A below. KE equal to D1 by P naught. I'm not adding any growth part, no flotation cost information. So I'm just writing D1 by P naught. What is the dividend they have mentioned? How much? DPS means dividend per share. Your DPS is dividend per share. 2.7. Market price 15 into 100. For every company, you will have to keep doing this calculation. When I do equity, I'll ask you the question, paying dividend, not paying dividend. When we do debt, redeemable, irredeemable, new issue, existing issue, all those questions will keep coming in. Next we'll go to firm B. Firm A only has equity. We are done with firm A's analysis. I'll have to put it in this format to get WACC. As of now, I'm getting the individual components. I'll put it in a sum format to get WACC. Next, firm B. Same formula for KE, D1 by P naught, D1 by P naught. What is the D1 here? P naught, 4 by 20 into 100. By 20 into 100, 20%. Any doubts on KE? Now I'll have to do cost of debt because firm B has equity as well as debt. Wait, before that, redeemable, irredeemable. Life is not available, it will become irredeemable. They need to give me what is the life of the instrument. Nowhere that is mentioned, so it will become irredeemable. Existing issue, new issue. Existing because it exists on the balance sheet of the company. When I do a next set of problem, I'll explain you when can I take new issue, existing issue. Some kind of changes will be done. I'll explain as we proceed. So it's an existing issue and it's a irredeemable debt. The question has talked about 1 lakh debentures and all. I'll do only for one debenture my calculation. Face value per debenture is 100. We will restrict ourselves to one debenture and do the calculation because that is going to be repeated for all. Now write cost of debt KD equal to interest after tax by net proceeds. Interest after tax by net proceeds. For one debenture, what is the interest we will pay? Normal interest, 10. So 10 into 1 minus, what's the tax rate? Point. I'm not teaching you anything new. Again, I'm repeating it. Nothing new is being taught. Exactly the same thing which we did in the last class. 10 into 1 minus 0.5. Net proceeds, existing issue, current market price. What is the current market price? 1. Do it and let me know. 10 into 1 minus 0.5 divided by 125. Ten into 1 minus 0.5 divided by 125. It is 4%. Exactly the same thing gets repeated here. Nothing new will be done. When new stuff will be done, I'll explain at that point of time. Any doubts on this? Clear? Can we proceed? Do for form C. Same formula. Form C. What is the dividend? How much? 2.88 divided by 12. This is 24%. Interest is 8 into 1 minus 0.5 divided by 80. The important step is this. If you are clear on this, the problem is almost over. Second step is more of a formality. Like in capital budgeting, we do step 1, step 2, step 3. Step 4 is just copy pasting stuff. So what we are going to now do is copy pasting these numbers. What is critical is still this. And this is already learnt in from problem number 1 till 25. Whatever we have learnt is only this. So we have seen multiple scenarios on debt calculation, multiple scenarios for preference, multiple scenarios for equity. Clear? Any doubts on this? Next, I'll now take you through WACC. First, I'll do firm B, then firm C, and then we come to firm A. Working note 2, calculation of WACC. Calculation of WACC. Write firm B and underline that below that. Firm B and underline that. You will require 6 columns. Open them as I say. Source, cost, the third is a main column called as weight, which will have 2 sub columns, and product will have 2 sub columns. So next is weight, WE. This is the format to get your weighted average, and then product. The 2 sub columns are book value and market value. So this is the format: source, cost, weight with 2 sub columns, book value and market value. Product with 2 sub columns, book value and market value. The WACC which we calculate will have 2 answers. Any problem or any scenario you have to do a weighted average. This is the format: source, cost, weight, product, or entity, cost, weight, product, whatever weighted average you want to take. Now listen, for firm B, what are the various components of capital? No need to see the question, see in your working note. Equity and debentures. Equity, debentures. What was the cost of equity we had calculated? 20. 20. Debentures. Clear? 20 and 4%. Now what is book value is, go to the question and see the balance sheet value. Whatever is the value, that is book value. What is the value of equity? How much? 2 lakh. What is the value of debentures? Listen for some time, I'll tell you when to note it down. I'll give you time to noting it down. 2,50,000 and 1 lakh. I'm just telling you, this step is more of copy pasting stuff. You're not going to calculate per se anything. You're just going to copy paste lot of things. So source, cost was written. Book value is 250 and 1 lakh. Now what is market value is, this 2,50,000, no, you divide by the face value. You will get the number of shares. That number of shares multiply with the market price. That is called as market value. Market value is the value of the shares in the equity markets or the debenture market. So 2,50,000 divided by what is the face value? So 25,000 into what is the market price? 20. So this will be 1 lakh divided by 100 into what is the market value per debenture? 125. So this is going to be 1,25,000. Any doubts on this? Now what is product is cost into weight. Cost into weight. Listen for some time. I don't want you to note down anything. Listen for some time. So you will just multiply the cost and multiply it with the weight. Similarly, this cost into weight, and you'll have to put a total of all of this. Now what is WACC's? Sum of product by sum of weights into 100. sum of product by sum of weight. I am not giving you any new formula. This is the formula for your weighted average. You would have learnt about weighted average in maths. This is the formula of weighted average. Sum of product by sum of weights into 100. Now, if you see in this calculation, the only extra thing which you calculate is this. Apart from that, everything else is readily available. I am not asking you to calculate anything. This will come from your step 1. Again from step 1, directly given in the question. You calculate market value. Product is just multiplication, and answer, 2 answers. WACC based on book value equal to 54,000 by 3,50,000. WACC based on market value is equal to 1,05,000 divided by 6,25,000. The only extra calculation is this. So let me know if at all there is a doubt on market value. How is market value is whatever number of shares are there into market price per share, whatever number of debentures are there into market value per debenture. Clear? Any doubts on this? Anybody has any doubts on this? So source and cost will come from step 1. Book value weight will come from question. Market value weight is to be computed. Product is a formula oriented answer. WACC based on book value equal to sum of product by sum of weights. WACC based on market value is equal to sum of product by sum of weights. If the problem is silent, I need to do both the approaches. Otherwise, some question will say do market value or do book value. Clear? Any doubts on this? Anybody has any doubts on this? Now write it down. I don't want you to copy it from the board. There's nothing there in the board for you to copy. Do it and let me know if you have doubt. Which one? Okay. Okay, on the market value, if at all you have a doubt, listen for a minute. How is market value computed? Is 2,50,000 divided by 10 per share. That is 25,000 shares into 20 rupees per share. Because this is the market value per share. 25,000 shares into 20. Similarly, 1 lakh divided by 100 into 125. What was the WACC? For book value it was 15.43 and 16.8%. You're done with firm C? You've started with firm C? Okay, so I'll just show you the answer for firm C. Any doubts on firm B? What was the cost of equity for firm C? 24.5. Book values were 5 lakhs, 2,50,000. Market value was 6 lakh and 17.67 and 19.25. 17.67 and 19.25. You're done with firm C. Firm B, firm C is done. Everyone done with firm C? Can you move to firm A? Sure. Complete it. Complete firm B and firm C. Again, I am repeating you. Step 1 is the major step. Step 2 is copy pasting. You are not going to do anything in step 2. So, if at all a mistake happens, it will ideally happen in step 1. Step 2, I don't see a scope for a mistake. It's just copy pasting stuff. Your role is to just copy paste numbers from multiple places, do some multiplication, do some division, and you're done with the answer. Let me know if there are doubts here. Now, the WACC questions will come for 10 marks. So, this is how exam questions will be. They will mostly come for 10 marks. If it's a very simple calculation, it will be for 5 marks. Otherwise, it will be a 10 mark question. Can I move to firm A? What is the answer for firm A? Did you do any calculation or straight away wrote it? It's a straight away writing 18%. There's no concept of calculation for firm A because there's only one cost of capital. How will you do a WACC? There's only one form of capital and the answer has to be 18% because there's no average of two numbers. Till now, average of 24 and 5 became 17.67 or 24 and 5 became 19.25, weighted average of. In case of firm A, why I didn't do firm A initially? Because firm A has only one form of capital. So, answer for firm A is directly 18%. Any doubts on this? Because there is only one form of capital. If you write source, cost, weight, product, you are wasting time. By writing source, cost, weight and product, you are going to waste time. Firm A will be a direct answer 18%. Any doubts on this? Be it book value, be it market value, use any approaches, it has to be 18 because there is only one form of capital. You will multiply with something and then divide by the same number. So, in the process, you will get only 18%. Clear? Any doubts on this? Any doubts on firm A? Anybody has any doubts on firm A? If somebody has done the calculation, you will get the same 18% only. If you have written source, cost, weight, product, you will get the same 18%. So, there is nothing much to explain. Can I proceed to the next question? Anybody has any doubts on this? Clear? Let's move to question 29. Can we? Everyone done with question 28? Can you move to 29? Okay, now listen. Determine the cost of capital of Best Luck Limited using the book value and market value weights from the following information. These are the four forms of capital. The weights are directly given. Book value is given, market value is given. Now some additional information is there. Okay, now please listen. When you do a problem on WACC, it is always an existing issue. Why it's an existing issue? Because a balance sheet has a value. A balance sheet will have a value only if it's an existing issue. Now, this information will become replaced by some other information if any additional data is given. To cut it short, if additional data is available, all of this will be used for step 1. That is, you will calculate as if you are going to do a new issue today. As if we are going to do a new issue today, we will calculate all of this, because the concept is WACC has to be based on current market condition, not based on what you have done historically. So what they say is, if they give any information, then take that extra information to solve the problem as if it's a new issue. If that is not possible, then solve the problem as if it's an existing issue. Wherever possible, solve the problem as if it's going to be a new issue. If not possible, then only you will solve the problem as if it's an existing issue. Last problem, no additional data. I told you, took the balance sheet data and move it. Now, this additional information will be for step 1. This is going to be for step 2. In step 2, you will copy paste this number. That additional data will help me in getting the step 1 information. I have 4 forms of capital. So first I'll do KE, then I'll do KR, KP, KD. We are done with the problem, put it in the format and done with the solution. Working note 1, calculation of cost of individual components of capital. Calculation of cost of individual components of capital. Cost of individual components of capital. KE equal to D1 by P naught minus F. D1 by P naught minus F plus growth rate. D1 by P naught minus F plus growth rate. Now listen, any problem where you do this P naught, the first priority is to find, is there an issue price? If that is not there, because issue price is the rule for a new issue and current market price is the rule for an existing issue. So any problem, if you can get data on issue price, please use that. Always when you do net proceeds, the priority will be issue price minus flotation cost. If that is not available, then only you will come to current market price. So anywhere you do, your first priority is issue price. If that is not available, go to the second priority, which is current market price. Clear? Any doubts in this? Now K is equal to D1 by P naught minus F. Now when it comes to D1, dividend at the end of the current year is what? 15. Listen for some time. Dividend at the end of current year is 15. Technically your D1. This is the dividend to be paid. Last 5 years dividends have grown. Now I need to find out what is the growth rate. Every year there is a growth which has been happening, and even at the end of the current year it is going to be 15. That is, from 14.19 it will become 15. So there is a growth even for the current expected year. Now listen, in the calculator, 15 divided by 14.19, 15 divided by 14.19 minus 1, 15 divided by 14.19 minus 1 into 100 to get the percentage. 5.71%. That should ideally be the growth for this company. Let's wait. I'll have to find out the growth, exactly what is happening. The basic thing is, present value is 10, future value is 14.19, n is equal to 5, r is equal to question mark. That r is basically the growth rate. In 5 years, dividends from 10 has how much from 10? 10.6. Now can you do in the calculator? Listen for some time. In the calculator, 10.6 plus 6%, do 5 times. See whether we are getting 14.19. I think the growth will be 6%. We got 5.71. 10.6 plus 6%, do it 5 times. 14. So ideally the growth rate for this question is 6%. How I got 6%? I'm explaining. 15 divided by 14.19. 15 divided by 14.19. Just a minute. Okay, 15 divided by 14.19, when you divide, you got some number. If you subtract 1 from it, that's the amount of growth I am doing into 100 to get it in percentage. That number was 5 point some number. So I am just going backward and adding 66% to see what is the growth rate. Now you have written the formula D1 by P0 minus F plus growth rate. Leave some 3 lines. Calculation of growth rate. Calculation of growth rate. Point number 1. The company paid a dividend of 10 per share. Dividend of 10 per share in year 0. Full stop. The same had grown to 14.19. The same had grown to 14.19 over 5 years. The same had grown to 14.19 over 5 years. Next point. Dividend for 6th year. Dividend for 6th year is rupees 15. Dividend for 6th year is rupees 15. Full stop. Tentative growth rate equal to dividend of 6th year divided by dividend of 5th year. Dividend of 6th year divided by dividend of 5th year minus 1. Dividend of 6th year divided by dividend of 5th year minus 1. From 5th year to the 6th year, what is the growth? 6th year dividend divided by 5th year dividend minus 1. You will get 5.71 approximated to 6%. Dividend of 6th year divided by dividend of 5th year minus 1. 6th year divided by 5th year minus 1. You will get 0.0571, which is nothing but 5.71% approximated to 6%. Any doubts on this? Dividend of 6th year divided by dividend of 5th year minus 1. Clear? Now listen. Listen for some time. I am writing plus 6% here. When I come to P0, if issue price is available, I will use issue price. If not available, I will use current market price. Always the priority is issue price. Why? Because we are going to make a new issue today. And again I am telling you, this should not be historical issue price. They will say the company issued shares 15 years back. I don't want to know that. I am asking, if at all, if you make an issue today. If it's 15 years back, then you better use the current market price itself. What our option is, for P0 purpose or for net proceeds purpose, it is the first priority is current issue price. What is current issue price? The second priority is current market price. The third priority will be the historical issue price, which I wouldn't even use it, but that is my third priority. My first priority will be current issue price. If that is not available, current market price. If that's not available, you go to the historical issue price or face value. Clear? Any doubts? Is there any current issue price they are talking about? They are saying equity shares and new issue priced at 125. So new issue will happen at the rate of 125. So denominator is 125 minus 5. 125 minus 5. 18 point. 18.5%. The first priority is always for a issue to be done. If at all an issue information is there. If not there, current market price. If not there, go with the rule of your face value. Any doubts on this? What's the second form of capital in the balance sheet? Retained earnings are same as cost of equity except for two conditions. Personal taxes. Anywhere any information on personal tax?
Any information on personal tax? Any information on flotation cost? Flotation cost is there. Then I cannot copy it. Now only thing is it will become KR equal to D1 by P naught. Same thing, P naught will be the same value, just that you will not do minus flotation cost. You are not required to do minus flotation cost. P naught will be the same what you have written above. You are not going to change all of that. The rules remain the same. Issue price not available, current market price not available, you go to the historical values and do it. D1 by P naught plus growth rate. It will be 15 divided by P naught is what? Growth is 15 by 125 plus 6%. KR is 18%. KE is 18.5. KR has to be lower than KE if these two things are there. Otherwise, it will be equal. In no circumstances, KR will be greater than KE. Any doubts on this? What's the third form of capital? Preference. Now they have said 15% preference share would realize what? 105. KP is equal to what by what? 15 divided by 105. 15 divided by 105. KP equal to 15 divided by 105. 15 divided by 105. 15 divided by 105. 15 divided by 105 was a number 14.28. Any doubts on this? Clear? The next one is cost of debenture. That's the last form of capital. Once I am done with this, the problem is over. I don't have anything beyond this. Once I am done with cost of debenture, your job is to put source, cost, weight. There also no calculation. Everything is readily available. And then product. You just need to do multiplication. Now when it comes to debenture, they say they are going to issue what? 11 year. 11 year means it's a redeemable debt. It's going to be a redeemable debt. We are going to pay how much? 15%. Yield is how much? 16%. Yield on similar maturity and risk classes 16%. I am giving 15%. People are expecting 16%. I give 15%. People are expecting 16%. Can I issue at par? Can I issue at premium? I have to issue at discount. So that I'll get it. I'll get the formula and get the issue price. Issue price minus flotation cost. Issue price minus flotation cost. First thing, it's a redeemable debt. Second thing, they should not have given me information on yield and all. If that was not given, issue price is face value. Because if the problem is silent, issue will happen at par. If the problem gives you some information, you will have to take that into consideration. Now write KD equal to interest after tax plus average other cost divided by average funds employed. Interest after tax plus average other cost divided by average funds employed. Divided by average funds employed. We'll take the face value as 100 and do the calculation. Now come down. Interest after tax equal to interest after tax equal to 100 into what's the interest rate? Into 1 minus what's the tax rate? You get interest after taxes 9.75. Interest after taxes 9.75. Any doubts on 9.75? Clear? Can we proceed? Now for average other costs, I need redemption value and net proceeds. Net proceeds is going to be a challenge here. So let's calculate that and then we apply in the formula. Now write net proceeds equal to issue price minus flotation cost issue price minus flotation cost. Today in the beginning I was giving a formula for fair market price of a debenture or issue price of a debenture. What was the formula? Issue price of a debenture or fair market price of a debenture. We did in question 11. Interest divided by investor expectation or current yield. So my issue price is going to be 15 rupees of interest. What I pay is 15 rupees. I get some tax benefit. That's a different story. 15 is what I pay. But people expect. So they are saying we will give you this much money only. 15 by 16% is what I'll pay. If you meet my expectation, at par. If you exceed my expectation, at premium. If you are not meeting my expectation, give me a discount. So it has to happen at a discount. 15 by 16%. In case I was paying 16 rupees, I would have been 16 by 16%, 100. If I was paying 16 rupees, it would have become 16 by 16%. But the problem is, I am paying only 15. So it's 15 by 16% minus flotation cost. What they have given on flotation cost? We'll take it as 2% of face value. Okay. For consistency, let's do 2% of face value for all of us. Or you can take 2% of issue price. In this problem, I am taking it as 2% of face value. 15 by 16% minus 2. How much? Any doubts on 15 by 16%? The base logic is meet my expectation, get 100 rupees, exceed my expectation, get more than 100, not meet my expectation, get less than 100. So that's the rule. If you're not meeting the expectation, please take a lesser money from me. Don't ask for 100 rupees. Clear? I'm done with the question. Now you do cost of debt. You have the formula, apply the formula and get me the cost of debt and then put it in the WACC. Get the cost of debt. My role is almost over. Now it's up to you. The problem is silent, redemption will happen at par. Now listen, listen for a minute. you do book value, market value has one small adjustment, so don't write anything on market value. Complete book value, source, cost, book value, market value, leave it blank. Book value, market value, leave the market value blank. I'll take you through that adjustment once you are done with book value. A small adjustment, not a great adjustment, but that will make a difference to your solution. Preference was how much? 14 point. Debentures was 1. It's 1 crore 20 lakhs. Retained earnings was the cost is 13.41%. Book value is not 13 point, sorry 16.83. Are you getting that answer? 16.83. Book value is 16.83. In market value, I just wanted to explain one adjustment. That's why I've told you to keep it on hold. I'm again repeating it. My major analysis will focus on step 1 only. Step 2 is just a copy paste work. You are not going to do any calculation per se there. Can I explain the adjustment of market value? Done with book value part? Any doubts? Okay, now please listen. Coming to the market value adjustment, you see, is there a retained earnings market value given, which is they have mentioned it as 0. The reason for that is when I buy Infosys Limited share, when I buy it in the market, I can buy the Infosys Limited share. The moment I buy it, I get access to equity capital as well as retained earnings. Because if company were to wound up, anything which is surplus will come back to me. So when anybody buys a share of a company, he buys share as well as the reserves and surplus of that company, because he becomes a part owner of the reserves and surplus also. Market cannot separately value equity and separately value retained earnings. They can only do a combined valuation. So what we do is, we will split this 2 crores in the ratio of 120:30. We'll split this 2 crore in the ratio of 120:30. Balance everything remains same. 1040 same. Debentures value same. This alone 2 crore has to be split in the ratio of 120:30. By doing that split, then you do the same calculation. That's the only adjustment needs to be done, because market cannot give a separate value for retained earnings and a separate value for equity share. It will be only a single value. Clear? Any doubts on this? Now do that 2 crore split in the ratio of 120:30. Split 2 crore in the ratio of 120:30. Basically 4:1. You'll have to split it in the ratio of book values. $16.83 and 17.20 is the answer. 16.83 and 17.20. We only have a lot of calculation to be done, but the crux remain the same. I'm not teaching you anything new. Again, I'll repeat the same stuff. We are not going to learn anything in these 6 questions which I'm doing. On WACC, nothing new is going to be learned. It's just repeating the same stuff with extra adjustments. 16.83 and 17.20. Done. Can we proceed? Let me know in case there are doubts here.
Can you proceed? Any doubts in this? Go through question 30. Please go through question 30. Okay, they've asked for WACC of Ganpati Limited using book value weights, market value weights. Same rules. We'll start with working note 1. I'll take you through working note 1. Working note 2, you will complete it. Working note 1, cost of individual components of capital. 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 Of individual components of capital. What the first form of capital given in the question? Which one? Debenture. Now listen for some time. They have given market price of a debenture. That is my second priority. I first look for issue price, second I look for market price, and third I go to the face value rule or the historical issue price. Third we go to historic. Now they have somewhere given this information. Rupees 100 per debenture, redeemable at par, 10% coupon rate, 4% flotation cost, and 10-year maturity. So basically they are indicating that a new issue will be done by the company. They are saying that a new issue will be done. In the new issue, flotation cost is 4%. Your maturity is going to be 10 years. So this will become a redeemable debt. This is going to become a redeemable debt. Clear? Any doubts on this? If this line was missing in the question, if this entire para was missing, what I would have done is, somewhere they would have mentioned here 12%. Some rate has to be obviously mentioned in the question. What we would have done is 12 into 1 minus tax rate divided by 105. We would have just divided by 105 and done with the question, because your net proceeds would have been current market price. That is my second priority. My first priority is always issue price minus flotation cost. In that, issue price either given or you go with the rule of face value. So first priority is your issue price minus flotation cost. The second priority is you're going back to your current market price. Till now, this is the only problem where I have taken current market price. Question number 28, we took the rule of current market price. 29, we have taken the rule of issue price minus flotation cost. Question number 30 also we will take issue price minus flotation cost. Why redeemable? Because 10-year life is given. Now write cost of debt equal to interest after tax plus average other cost, interest after tax plus average other cost divided by average funds employed. Interest after tax plus average other cost divided by average funds employed. Interest after tax plus average other cost divided by average funds employed. What is the rate of interest? 10. Tax rate? So write 10 into 1 minus 0.5 plus
10 into 1 minus 0.5 plus 10 into 1 minus 0.5 plus, what's the redeemable value? 100. Redeemable value is 100. Redemption value minus net proceeds by life. Average other cost is redemption value minus net proceeds. When it comes to net proceeds, issue price minus flotation cost. Net proceeds will be issue price minus flotation cost. What is the issue price? Issue price is 100, flotation cost is 4. Issue price is 100, flotation cost is 4. So 100 minus 96 divided by 10. 100 minus 96 divided by 10 divided by 100 plus 96 by 2. Hun 10 into 1 minus 0.5 plus 100 minus 96 by 10 divided by 100 plus 96 by 2. What is this cost? 5 point. Then what is the next form of capital? Preference. When it comes to preference, again they have given some information. 100 preference share redeemable at par, 5% coupon rate, 10-year maturity. It became a redeemable preference share because there is a 10-year maturity. Write the formula. KP equal to, what is the formula? Preference dividend plus average other cost divided by average funds employed. Preference dividend plus average other cost divided by average funds employed. What's the amount of preference dividend? 5. 5 plus, I've done this multiple times, so I'm not explaining in detail. In case you need an explanation, let me know. 5 plus 100 minus 98 divided by 5 plus 100 minus 98 by 10 divided by 100 plus 98 by 2. How much? 2. For preference and debenture, the question is whether it's redeemable, irredeemable. For equity, the question is whether it is paying dividend, not paying dividend. Accordingly, the formula will change. Coming to cost of equity, is the company paying dividend, not paying dividend? Paying dividend, and the next expected dividend is one with an annual growth of 5%. So it's a constantly growing dividend. What is the formula? KE equal to D1 by P0 minus F plus growth rate. D1 by P0 minus F plus growth rate. Minus F needs to be done for equity. You will not do minus F for retained earnings, if retained earnings are there. What is the next expected dividend? The next year expected dividend is 1 with an annual growth. Now listen, coming to P0, do you have issue price in the question somewhere? If issue price is there, you take that, otherwise we move to current market price. Issue price for the equity share, like last problem said 125, like that anything is given? No. So then I shift to current market price. What is the current market price? 24 minus 4. The logic is you will be able to make an issue at the current market price of 24. That's the logic we are applying here. 1 divided by 24 minus 4 plus what's the growth rate? 5%.
Now my role is over. You will put it in the step 2, source, cost, weight, product, get the answer for book value, get the answer for market value. We'll check in 5 minutes. Do source, cost, weight, product. Put it in that format. There is one hidden adjustment, so take care of that. If you make a mistake, you correct it later on. There is one small adjustment, please take care of that. Don't wait for the solution, you end up doing it. If you make a mistake, it's perfectly fine, but please do it.
What is the cost of equity? %10, no. Yeah, preference? 5.25. Debenture? Value of equity is 1055. Equity is 10 lakhs. 5 lakhs. 5 lakhs. The only thing is, when you do market value, you will have to adjust based on the market price. I assume you have done that. That's where that market price data is there. They have given the market price data of 24, 110 and 105. Where is that going to be used? Here. This divided by 10 into 24. This divided by 10 into 24. Preference, what is the market value? Into 110. Debenture divided by 100 into 105. The only purpose of the market price is this. I am now going to use it in my calculation. What happened? We are not using it in the calculation for step 1, because step 1 the rule is issue price minus flotation cost. If that is not there, then only you take the help of the current market price. So there we did not take it, but here obviously I'll have to take it, because market value weights means what is the market value? You will have to go by market value. The answer is 7.69 and 8.57. 7.69 and 8.57. $7.69 and 8.57. What happened? Some of you look a little confused, so I'm not sure. Is there an issue with this question? Did you do this adjustment or not? Market value adjustment. The market prices were given for only this purpose in the question. Otherwise, that's of no use. 7.69 and 8.57. Any doubts? Can we proceed? Any doubts on this? Clear? Can you move to the next question? 7.69 and 8.57. You'll have to write both the answers. WACC based on book value is 7.69%. Based on market value is 8.57%. We'll move to question 31. Now, we'll start. The following is the capital structure of Siemens Company Limited as on 31/12/2010. 4 forms of capital is there: equity, retained earnings, preference, debentures. Market price is given. Dividend is expected to be 10. Growth rate. If the company is in 50% tax bracket and investors tax rate is this, compute WACC based on book value and market value. Assuming that in order to finance an expansion, the company intends to borrow something, this financing decision is expected to increase dividend. However, the market price is expected to decline, and we are required to answer revised WACC. Only additional part is this. The second part of the question is going to be new to you, something called as a revised WACC. First part is what we have been doing till now. There is nothing new there. So let's start with part 1 of the question. In part 1, step 1 is cost of individual components. Step 2 is WACC. Working note 1, calculation of cost of individual components of capital. Calculation of cost of individual components of capital. Cost of individual components of capital. Cost of individual components of capital. Can we start? What's the first form of capital? KE equal to paying dividend, not paying dividend, paying dividend, constantly growing, no growing, constant growth of 6%. K is equal to D1 by P naught minus F plus growth rate. K is equal to D1 by P naught minus F plus growth rate. D1 by P naught minus F plus growth rate. What is D1? Dividend of 10 per share would be declared for the year 2010. Now please listen, I'll have to write an assumption. Whether it is D0 or D1, I have told you the rule is, when they say would be declared for 2010, it will take time for them to declare and the payment will happen. If this time period is something like 1 to 2 months, then it is technically D0, because you invest and immediately get it. If it's going to take 6-7 months time, it is D1. Always there will be a confusion on this. You will have to write your assumption. It is assumed that dividend of 10 per share is distant dividend in bracket D1. It is assumed that dividend of 10 per share is nearby dividend in bracket D0. I'll take it as D1. I'm taking it as D1 and proceeding. You will have to write a note on this. This area will always be ambiguous. You will not be very clear what is to be taken. So write K1 equal to, sorry, KE equal to, what is the D1? 10. P naught, any flotation cost, growth rate, %15.09%. Any doubts in this? I've been doing the same thing in the last class, this class, we have been doing the same thing. Lot of mini problems, that's all. You keep doing KR, KE and cost of debt. What is the next form of capital? Now listen, KR will be same as KE if there is no flotation cost. Any flotation cost in the question? Personal taxes. They have given the personal taxes. They have said investors tax rate is something. So let's use the formula. KR equal to KE into 1 minus personal tax rate into 1 minus flotation cost percentage. 1 minus personal tax rate into 1 minus flotation cost percentage. 15.09 into, what is the personal tax rate? 1 minus 0.2 into 1 minus 0. Flotation cost is 0. 1 minus 0.2 into 1 minus 0. .12. Any doubts on 12.07%? What's the next form of capital? Preference. KP equal to any information on life anywhere in the question? No. Preference dividend by net proceeds. Preference dividend by net proceeds. Preference dividend by net proceeds. How much is the preference dividend per share? 10. Net proceeds. Net proceeds is a hidden information. Where is it hidden? It's hidden here. 4 lakh and 4 lakh 40,000. The rules are you go with issue price minus flotation cost. Not available because there is no information on issue being done. The second option is market price. How do I get market price? If 100 rupees is face value, you have 4 lakhs worth of book value. 4 lakh by 100 is how many debentures? Sorry, how many preference share? 4,000. Then the market value per preference share is 4,40,000 divided by 4,000. 4,40,000 divided by 4,000, which is how much? 110. Clear? Any doubts on this? It's a hidden information. They have not directly given. 4 lakh and 4 lakh 40 tells you that it is 110 rupees per preference share. Ten by 110. 9.09%. 10 by 110 is 9.09%. Any doubts on 9.09%? Can we proceed? The last one is cost of debt. Any information on life anywhere? Anything given in the question? So, interest after tax by net proceeds. Interest after tax by net proceeds. You assume face value of 100 and do this question. Any number you can assume, 10, 100, that doesn't make a difference. Take 100 and then let me know the answer. Interest after tax by net proceeds. You can take it as 100 and then do it. Interest after tax by net proceeds. What by what? 6 divided by, it's 120, it's not 100. 6 divided by 120. Face value is 100, market value will be 120 in this case. You take face value as 10, market value will be 12. How is the calculation? Is 6 lakh divided by 100. 6,000 debentures are there. If 6,000 debentures are there, the market value will be 7,20,000 if each debenture is 120 rupees. If 100 rupees is the face value, market value will be 120. If 10 rupees is the face value, market value will be 12. Your wish, you want to take it in any way, do it. But the basic thing is, if you take it as 10, the interest will be lower and denominator will be lower. If you take it as 100, interest will be higher, denominator will be higher. Net answer will be same. What is the interest we are paying? 12 into 1 minus 0.5 divided by 120. 12 into 1 minus 0.5 divided by 120. Any doubts on this? 12 into 1 minus 0.5 divided by 120. How much? Any doubts on 5%? Clear? Source, cost, weight, product. Do it and let's get the part 1 first. Revise WACC, I'll take you through. First, let's go to complete the part 1. What is the cost of equity? 15 point 12 point. Preference was debentures is the market value of equity has to be split in equity and retained earnings. Has to be split in equity and retained earnings in the ratio of 10:1. The market value of equity, which will be nothing but, just a minute, it will be 10,000 shares into 110. The market value of equity is 10,000 shares into 110. This has to be split in the ratio of 10:1. 10,000 into 110 split in the ratio of 10:1. 10,000 into 110 split in the ratio of 10:1. Into 110 split in the ratio of 10:1. This is the first part of the question, WACC. Again repeating it, your main focus should be on step 1. Step 2 is just copy pasting numbers. Can I proceed to part 2? Any doubts on part 1? Everyone done with part 1? 10.92 and 10.57. There's nothing much to learn, it's just multiplication, division, you keep doing that and you get to the solution. 10.92 and 10.57. Can you proceed? Okay, now please listen. Now, first we do a normal WACC, then they will say that they are going to spend something or increase some capital. So, what they are mentioning, assuming that in order to finance an expansion, the company intends to borrow a fund of 10 lakhs. Till now we have 4 forms of capital. The 5th form of capital is a new capital called as 14% debt. It's a 14% rate of interest. So, I call it as 14% debt. I don't know whether it's debentures or term loan, whatever way they want to take, but it's 14% debt. How much they are planning to take is 10 lakhs. Now, listen for some time. What will happen is, we have this 4 forms of capital. You'll, in between, the 5th form of capital will come. That is called as 14% debt. I've just added another form of capital called as 14% debt. If the problem does not give any information on how are they going to fund it, then issue price, book value as well as market value will be same. How much money they want to raise? 10 lakhs. Listen for some time, I'll tell you when to note it down. 10 lakhs and 10 lakhs. I've just increased by 10 lakhs and 10 lakhs. It's a 14% rate of interest. The cost of a debt is, if no information is there, it's interest into 1 minus tax rate, because your par value, face value and issue price will remain same. So in that case, what happens is, if they give a 14% rate of interest, what is the tax rate in this question? 50%. So the cost of 14% debt is 7. The cost of a 14% debt is only 7%. Any doubts on this? Now it doesn't end here. This is second part of the solution. But before doing this, I have to do a check. What is the check we need to do is, you are now going to write this. Any information given in the question which talks about any change in the cost of debentures. Earlier debenture, nothing. Preference will not change, but equity will change. Why will it change? Earlier you did 10 by 110 plus 6%. Now they said it's no more 10. What are they saying? Now they are saying 12. Dividend is 12. See, earlier it was 10 divided by 110 plus 6%. Now it will become 12 divided by 105 plus 6%. When this changes, KR will automatically change. Why KR will change? KR is KE into 1 minus flotation cost into 1 minus personal tax. It doesn't end here. So these two will undergo change. No information on preference change, no information on debenture change. So now we are going to rework these two steps. This is altogether a new problem. You can understand it's altogether a new problem. So next, working note 3, cost of individual components of capital. Cost of individual components of capital. Cost of individual components of capital. It's going to be 5 forms of capital. I'll write the cost for all the 5 forms. If no change, I'll copy paste. If change, I'll change it. Clear? So KE equal to D1 by P0 plus growth rate. D1 by P0 plus growth rate. If nothing was given, we would have copy pasted 15.09. D1 by P0 plus growth rate. It is what by what? 12 by 105 plus 6%. How much? 17.42%. 4? Okay, sorry, 4.3 then. ठीक है. 17.43%. Next, KR equal to KE into 1 minus personal tax rate. KE into 1 minus personal tax rate into 1 minus flotation cost percentage. 1 minus personal tax rate into 1 minus flotation cost percentage. Do it and let me know the number. 13 point. Any doubts on this? Anybody has any doubts on this? Can we proceed? KP equal to copy paste. KP equal to whatever was there earlier. KP equal to 9.09. KP equal to 9.09. Then you write it like this: cost of existing debentures. Cost of existing debentures. Cost of existing debentures equal to what percentage? 5%. And then cost of new debt. This is an extra amount which is coming into capital. Cost of new debt is equal to interest into 1 minus tax rate. If they don't give any additional information, it's just interest rate into 1 minus tax rate. Interest rate into 1 minus tax rate. Interest rate into 1 minus tax rate. How much? 7%. Any doubts in this? Clear? Can we proceed? Put it in the structure and get the WACC. Please put it in the structure. Source, cost, weight, product. It is just that earlier problem had 4 forms of capital, now we have 5 forms of capital. Earlier had 4 forms, now we have 5 forms of capital. From 4 forms of capital, we have moved to 5 forms of capital. There's one adjustment he has already pointed out, otherwise I would have told in the end. It is 10,50,000 now when you do market value of equity and retained earnings, because the price has fallen to 105. From 110 it has fallen to 105. I would have told in the end, but now you guys can note it down. It is 105. So this would have become 10,50,000. I think with that the problem is over. So I don't have anything else to explain. This was an hidden adjustment which I wanted to explain in some time. 10,50,000 split in the ratio of 10:1. Price falls from 110 to 105, so we will have to take care of that. 110 to 105 fall. Complete this. I'll end it with this.